AI is everywhere today. From chatbots to automated trading algorithms, it's transforming industries and reshaping the global economy. But history shows that every major technological revolution brings massive economic shifts, opportunities, and risks. In this video, we'll explore how past technological booms can help us understand the AI revolution today, uncover patterns that repeat across centuries, and examine the risks and lessons every economy faces during these periods of rapid innovation. Let's begin with history. The first industrial revolution in the 18th century didn't just introduce steam engines and factories. It fundamentally changed how money, labor, and markets worked. Entire industries emerged, urban populations grew, and economies boomed. But this progress came with risks. Boom and bust cycles, exploitation, and temporary job displacement were unavoidable consequences. History shows us that innovation is rarely smooth, and financial systems are often challenged by the scale of change. Fast forward to the late 19th and early 20th centuries, and electricity and mechanization reshaped productivity once again. Businesses could produce far more with less effort, but not all sectors adapted equally. Many traditional industries struggled, while new sectors thrived. Patterns emerge. Every major technological advance creates winners, losers, and temporary economic stress. The key is understanding these patterns and the underlying financial mechanisms. Then came the computing revolution. Mainframes in the 1960s, personal computers in the 1980s, and the internet in the 1990s all boosted productivity dramatically. But they also created speculation and bubbles. The dot-com bubble of 2000 is a clear example. Companies with no profits attracted massive investment, and stock valuations soared far beyond economic fundamentals. This pattern, innovation fueling both growth and hype, has repeated throughout history. Now AI is the latest revolution. According to the International Monetary Fund, global AI investments surpassed $500 billion in 2025, and adoption is accelerating across industries such as finance, healthcare, logistics, and marketing. The productivity gains are real, but risks are equally present. Overvaluation, market volatility, and temporary job displacement are all part of the economic landscape, just as they were during past technological revolutions. AI also interacts with financial systems in new ways. Algorithmic trading, automated credit scoring, and AI-driven risk models accelerate market dynamics, creating both efficiency and potential instability. Economists study historical cycles to identify patterns in how technology reshapes economies and financial systems, providing lessons that are invaluable for navigating the present. What can history teach us about these patterns? First, booms always bring risk. During the dot-com era, investor excitement outpaced reality, and speculative bubbles formed. Today, AI is generating similar hype. Startups and corporate investments are surging, and valuations are skyrocketing. Understanding this context helps us separate potential from speculation. Second, labor and productivity shifts are temporary but impactful. Industrialization displaced many jobs, yet it eventually created wealth, new industries, and long-term economic growth. AI may displace certain roles, but it will also create entirely new markets, new forms of employment, and opportunities for innovation. Recognizing these patterns helps us anticipate challenges while appreciating the broader benefits. Third, regulation and policy play a critical role. Throughout history, governments guided technological transitions, from the railroads to electrification, determining who benefits and who bears risk. Today, central banks, fiscal policy, and international agreements will influence AI's economic impact, shaping outcomes across industries and populations. Let's examine a few historical parallels. The Industrial Revolution saw massive urban migration as rural laborers sought factory jobs. Productivity soared, but social and economic inequalities emerged. Similarly, the computing revolution displaced some roles while creating entirely new sectors like software, IT services, and tech infrastructure. AI may follow a similar trajectory. Some jobs will disappear, but new opportunities in AI development, monitoring, and ethical oversight will emerge. Financial systems also experience repeated cycles during these revolutions. During the dot-com bubble, market speculation reached unsustainable levels, creating widespread risk. In the industrial era, banking crises occasionally disrupted economies as investment and credit expanded too rapidly. Today, AI-driven investments are creating new forms of market concentration and volatility, and regulators are starting to analyze potential systemic risks before they materialize. Global debt and fiscal considerations are another factor. Emerging economies today face rising debt levels, and large-scale AI investment could amplify financial risks if not managed properly. Historical case studies, from post-war reconstruction to the 2008 financial crisis, demonstrate that innovation interacts with debt, capital flows, and policy in complex ways. Understanding these patterns allows us to anticipate challenges without making predictions. Let's look at productivity trends. Industrialization increased output but initially reduced wages for some sectors. Electricity and mechanization further boosted production but also disrupted traditional labor markets. Computing and the internet created massive efficiency gains but required new skills and education. AI is likely to accelerate productivity even faster, meaning that education, skill development, and reskilling programs will be more important than ever. One of the most important lessons from history is that financial literacy and informed decision-making are critical. Economies that understood debt cycles, inflation, and risk were better able to navigate technological disruptions. AI is no different. Understanding market trends, adoption rates, and economic implications helps businesses, policymakers, and individuals respond wisely to change. AI also highlights the relationship between innovation and global competitiveness. Just as countries that led industrialization gained long-term economic advantages, nations that strategically adopt AI may gain a significant edge. But history also warns us that over-reliance or speculative investment can lead to financial bubbles and systemic instability. Patterns repeat, and those who study them gain insight. Let's talk about risk. Every technological revolution carries financial, labor, and societal risks. AI may exacerbate income inequality if certain populations are left behind, just as industrialization did centuries ago. Market volatility may increase, and new regulatory challenges will emerge. But by looking at history, we can identify mitigation strategies, such as responsible investment, workforce reskilling, and transparent governance. Another key lesson is timing. Innovations do not affect all sectors simultaneously. During the industrial era, textile workers experienced rapid change, while agriculture evolved more slowly. During the dot-com bubble, internet startups surged while traditional sectors remained stable. AI is likely to impact some industries immediately, while others will experience gradual adoption, creating a complex but navigable landscape. From a financial perspective, history teaches us that speculation often precedes sustainable growth. Investment in AI may follow similar trends: initial hype, rapid growth, corrections, and eventual long-term productivity gains. Recognizing these cycles helps investors, businesses, and policymakers make informed decisions without falling for overhyped promises. So, what are the big takeaways? First, patterns repeat across history. Second, every technological revolution drives productivity, growth, and risk simultaneously. Third, understanding financial systems, economic cycles, and historical outcomes is far more valuable than trying to predict the future. AI is powerful, transformative, and disruptive, but it fits into a long pattern of human innovation that we can study, understand, and learn from. AI represents a monumental shift in how economies operate, but history shows us that patterns of disruption, adaptation, and growth are predictable in structure, if not in exact outcome. By examining past technological revolutions, from the Industrial Revolution to the computing era, we can better understand the societal, financial, and economic effects that AI may bring. From job displacement to market volatility, from productivity surges to financial speculation, AI is part of a continuum that spans centuries. Every major innovation reshapes economies, redistributes wealth, and creates both risk and opportunity. By studying the past, we gain insight, context, and perspective. Subscribe to Money and History to explore how money, markets, and innovation evolve over time. Learn the patterns, understand the risks, and see how today's AI revolution fits into the long story of human economic history. Through evidence, historical analysis, and careful examination of modern trends, we can navigate this new era with knowledge, rather than guesswork. Remember, every revolution has lessons to teach. AI is no different. By observing patterns, understanding risk, and examining historical parallels, we can approach the future informed, prepared, and empowered.